Hello, welcome to module 12, which is going to accommodate the valuation of business, or in other words to evaluate the economic worth of a business related to the different dimensions of the body corporate. To start with, when you are going to talk about the valuation pertaining to the business entity, it is imperative on the part of the valuer and at the same time on the part of the vested parties who are interested in valuation to have a sufficient understanding about the concept of valuation. When you are going to talk about valuation of a business, we are more or less into the protocol of ascertaining the economic worth of a business, or what is the value of the business, and it is sensitive owing to the simple orientation that there may be the protocol of business combinations, there may be the protocol of executing investment decisions, there may be the protocol of extending finance on a long term basis by the suppliers of capital, and so on and so forth. All the parties having varied interest are intending to know what is the legitimate value of a company. Now here it is necessary to understand what is value and how does that differ from that of the concept of price, because there lies anomalies with regard to the usability of these two terms, price and value. When we are talking about price, it is essentially the monetary consideration which is placed against a particular asset. But on the contrary, when you are going to talk about value, we are more or less into the process of digging out whether the monetary compensation paid against a particular asset, like in this case it is the business, is worth it or not. So value is a broader and holistic concept compared to price, which is more or less dictated by the market pervasive forces and not necessarily reflect the worth of that asset so far as the price is concerned. But when we are talking about value of a business, we are intending to know pragmatically whether the monetary consideration paid in lieu of a particular asset is worth it or not. So that's why the value or the valuation of a company is sensitive at the end of the users community when they are into the protocol of taking different financial decisions backed by their vested objectives. Here, business valuation can be executed using different models which have been propounded by the passage of time. And there has been continuous and perpetual improvement with regard to different business valuation models over the years, and we are moving from the more orthodox models to the contemporary models which are going to imbibe different practical aspects of business nowadays. Now, what is a business valuation model? Essentially, business valuation models are organized techniques for calculating a company's economic worth. The fundamental concept is to assess a company's current value by evaluating its potential to create value in the future, the worth of its assets, or comparisons to other businesses of a similar nature. Now, the essence of all the business valuation models are to calculate the economic worth of a body corporate. Now, the economic worth of a body corporate is going to be conditional upon many aspects which are not only related to past or present, but at the same time they are related to the future states of affairs of a particular company. Because what we are going to pay in terms of monetary consideration today as the value of a business, obviously we are going to expect to fetch such monetary consideration what we are paying today by carrying the particular asset into a future span of time. So it is imperative while making use of business valuation models to consider and accommodate all those aspects which are going to have a bearing on the future states of affairs of a business, though we are computing the value today. But we all know that the value what you are going to compute about a particular company is going to reflect the future expectation with regard to generation of revenue, with regard to generation of cash flow, and so on and so forth. Moving further, when you are going to talk about the business valuation models, what purpose does it serve at the end of the large and diverse users community? Here I have jotted down some of the essential purpose which the business valuation models are going to serve. The first one is buying or selling a business. We all know that it is the age of conglomerations. It is the age of combination of different businesses, may it be in the form of acquisition, may it be in the form of mergers, may it be in the form of amalgamations, may it be in the form of takeovers, and so on and so forth. So, in whatever may be the business combination, always before that it is essential on the part of the parties concerned to a business combination to legitimately calculate the value of the business, otherwise it is not possible to execute a deal, whether it is merger or acquisition or takeovers. So, without calculating the value in a legitimate manner, it is not practically feasible to go for any form of business combination. So, it serves the formidable purpose of facilitating different forms of business combination which are significantly witnessed nowadays in the business ecosystem. Moving further, it is also contributing towards raising capital or attracting investors. This is one of the most fundamental contribution of valuation of a business. Say for example, if a particular business is going to apply for a long-term loan to a financial institution which is going to be repaid for a span of 10 years or 15 years, then that financial institution is inclined to know what is going to be the value of the business before taking a decision with regard to whether the particular amount of loan is to be sanctioned or the application is to be rejected. So, on the part of the business, it is essential whenever they are going for mobilization of capital, they are there to disclose and disseminate the value of the business before the interested parties. And at the same time, when we are talking about investors who are more or less intending to invest in different body corporates, they are also equally interested to calculate what is going to be the value of the business and whether the price what they are ready to offer is worth it or not. So, for that the valuation of a business carries utmost significance at the end of the financial institutions, at the end of the investors, to serve their vested purposes. Then moving further, it also facilitates the mergers and acquisition deals. We all know that nowadays with the opening up of the economies and the markets, there lies examples of different forms of business combinations, and out of which the most popular forms of business combination is mergers or acquisitions. But the core of that particular business combination lies there in the ascertainment of the value of a business, because without ascertaining the value of the business, there is no other way out to finalize the merger or acquisition deal and to go for a proper due diligence when we are talking about mergers and acquisitions, owing to the simple reason that it may so happen that we are going to go for a merger decision today, but the consequence or the outcomes of such decisions what we are executing today is going to have substantial bearing on the future of that merged entity or the acquired entity. So, it is imperative on the part of both the parties to the form of business combination is to calculate the value of a business in its real sense. Moving further, It also contributes towards regulatory issues. We all know that there prevails a lot of conflicts and criticalities associated with the business world in the form of conflict of interest among two parties, say shareholders, conflict of interest between board of directors and the managers, conflict of interest between two entities who have gone for a golden handshake, and so on and so forth. So, to resolve such conflicts, it is necessary on the part of those regulating agencies to ascertain the value, and on the basis of the value they are going to come out with some proposals so that the particular business conflict can be set right and can be resolved. Otherwise, the protocol of resolving a conflict in a state of subjectivity, as we all know that there prevails a lot of subjective compliance to different business conflicts, but that is not scientific and that is not leading to any robust outcome so far as the experience which are witnessed in the business world. Then moving further, the last one is it also contributes towards financial reporting and internal planning. When we are talking about financial planning, financial reporting, obviously we are at the back of mind trying to disclose and disseminate about the financial states of affairs of a business to the best of our potential. We are there to ensure that there is no prevalence of any impairment of assets. There is no prevalence of any selective disclosure. There is no prevalence of any subdued orientation while we are talking about the financial statements. So, for that purpose also, if we are there to have sufficient orientation and exact information pertaining to the value of the business, we can facilitate the vested objective of financial reporting, which is serving a larger community of stakeholders. Then there comes the internal planning. Even the managers, the CEOs, the board of directors, they are also equally interested to know what value the business is going to possess when they are more or less resorting to the task of executing different plans, whether related to internal states of affairs or related to competition emanating from the peers or related to address different challenges emanating from the vulnerable conditions of market and market policy forces. So, as a whole, the business valuation models are contributing significantly towards this. Then moving further, when you are going to talk about usefulness, now there prevails a lot of contributions. The first one is informed decision making. This is one of the common outcome of business valuation model, because without the availability of cogent and exact information about a business, it is rather a subjective approach to arrive at any decision with regard to that particular business. Then there comes capital requirement. On the basis of the valuation of the business, we can ascertain whether the business is going to need more capital or the business is overcapitalized. So, accordingly, we are there to go for different activities which leads to arrangement of capital at the end of the business and going for the so-called orientation by tapping different sources of mobilization of capital. Then there comes business combinations. As I said just before while discussing the purpose, one of the fundamental usefulness of valuation model is to facilitate business combination. Then there comes confidence to investors. Obviously, the investors are intending to know what value a particular business is going to possess before resorting to the final task of executing an act of investment in such companies. So, it is rather pivotal at the end of the investors to dig out the value of the company before executing any act of investment. Moving further, it also contributes towards strategic planning. The strategic planning may be related to the improvement associated with internal states of affairs, maybe related to reducing the risk emanating from the business ecosystem, or maybe related to the level and the magnitude of competition from the peers, because we as an economic entity, we are there to handle all these challenges which are emanating either from internal orientation or from external orientation through proper execution of strategies and making plans accordingly, so that we can be in a position to address all the challenges, and we are there to come out of the threats or unfavorable consequences of all the challenges through strategic planning. Then there comes legal compliances. We are also answerable to different regulating agencies who are playing the role of watchdog so far as the body corporates are concerned, and they are also equally interested to know exactly what is the value of a company. So, for example, when you are going to talk about stock exchanges, they are making it mandatory on the part of all the listed companies whose shares are getting traded in the stock markets to disclose and disseminate the financial statements for the use and accessibility at the end of the investors. What is the very purpose of the National Stock Exchange or any stock exchange to make it binding and mandatory? It is simply due to the fact that all the users or the investors or the parties who are having any direct or indirect bearing with the stock market would be in a position to know what is the value of the firm, and accordingly they are there to appraise the price at which the shares are traded, whether it is underpriced or overpriced or fairly priced. So, on the basis of the valuation of the business, we are in a position to say whether the price is fair or underpriced or overpriced. So, without ascertaining the value of a company or a business, it is not practically viable at the end of the investing class to dig out what it is. So, legal compliance is there. Then there comes financial reporting. As I said, we are there to ensure whether there is an impairment of assets or selective disclosure of liabilities when you are going to talk about financial reporting, because we all know that there prevails heavy element of window dressing, heavy element of misrepresentation, heavy element of financial distortion so far as financial reporting is concerned. So, if the value of a company is available and calculated to the best of its orientation, then there is less probability or likelihood that a company, while disclosing the financial variables through financial statements, may it be income statement, may it be balance sheet, may it be cash flow statement, that probability of executing the act of window dressing or distorted disclosure going to get less. And at the end of the orientation, when we are talking about financial reporting, essentially we are doing such to disseminate the information in the best possible way, which facilitates informed financial decision making. Then there comes the last one, that is financial benchmarking. We all know that whatever may be the company, irrespective of size, scale and operation, the particular company is there to execute and operate within the broader ecosystem of business. And all the time they are keeping an eye on their peers. What is the performance of their peers? What value they are fetching in the market so far as the investing class is concerned, and so on and so forth. So, when we are going to compare ourselves with our peers or with the industry benchmark, it is the value of the company which comes at the forefront, and that serves the purpose of financial benchmarking in the best possible way without any element of subjectivity. Otherwise, benchmarking are also getting executed on a state of subjectivity, which is not going to be taken by the users community in a favorable orientation. Then moving further, there are different business valuation models which are in practice and which got evolved over the passage of time. We classify all these business valuation models into three broad categories. The first one is income based valuation models, the second is asset based valuation models, and the third value added models. Now, when you are going to talk about income based business valuation models, at the core of it we are paying heed to the income or the ability of a business to generate income, not today but down the line in the longer span of time, to dig out the sustainability of the business. So, for that there prevails two different models which are extensively used in the corporate world. One is the discounted cash flow model and the other one is the capitalization of earnings model. When we are talking about discounted cash flow model, that is one of the celebrated model used nowadays most extensively by all the merchant bankers, investment bankers and the critical analysts which are serving the corporate world to the best of their potential, owing to the simple reason that discounted cash flow model is theoretically sound and scientific by its approach, which accommodates the realistic orientation of different financial variables which are going to lead to the value or the economic worth of a business. Now, that we will be discussing with greater detail in the subsequent lectures under the same module, but for an introductory orientation, we must make a mention of the fact that discounted cash flow model is based on the most contemporary approach of free cash flow, and free cash flow is the latest approach which is adopted in the financial world whenever we are talking about any legitimate financial decisions that are expected to be arrived at. Then there comes capitalization of earnings model. Here we are paying attention to the earnings of the business and we are expecting that the business is going to continue with the same level of earning, and we are carrying n number of assumptions so far as this particular model is concerned. That's why compared to discounted cash flow model, this earning capitalization model is less adopted and used by the different users who are backed by the very objective of taking informed financial decisions. Then there comes asset based valuation models. The asset based valuation models leads to three further variants. Either we can go for a book value orientation, or you can go for a liquidation value, or you can go for net asset value. Now, out of all these three, it serves different purposes, it serves different dimensions and different objectives. To start with, here let me make a mention of all these three models which are falling under the purview of asset based business valuation models briefly. When we are talking about book value model based on assets and liabilities of a business, we are carrying the historical costs which are getting disseminated in the balance sheet, and we all know that balance sheet carries the assets and liabilities together and reflects different values what the assets and liabilities are assuming based on the historical cost. And this is the most elementary model of asset based valuation model, which only talks about the historical values what it assumes so far as assets and liabilities are concerned, without paying any attention what value it is going to fetch if it will be revalued at present. So, it is completely based on the historical orientation. That is why we do not make use of these models nowadays, but they were extensively used in the past so far as valuation of business is concerned, owing to the simple aspect of being clear and easy to ascertain the value of the firm. Then there comes liquidation value. This is the model which is adopted when we are going to assume that the business is going to be winded off or is more or less into a state of liquidation. So here we are there to recalculate and ascertain the value of assets as if we are going to sell all those assets as a forced orientation in the market. But there prevails a lot of subjectivity with regard to liquidation value based asset models, owing to the simple reason that it is very difficult to calculate the value of the assets which have already been used in the market, owing to the simple reason that the assets are already in use. So it is rather difficult and practically not feasible to calculate or ascertain the value of a second hand asset. So there are certain impediments to this model also. Then there comes the net asset value method, or it is more popularly known as adjusted book value approach, where we are calculating the fair price which we may fetch by putting all these assets in the market. So essentially the NAV method is based on fair value approach by carrying the fair value what a particular asset is going to fetch if it is there in the market. So it is comparatively a better orientation to that of book value and liquidation value model. Then there comes the third world, that is valuation based on value added orientation. Under this, we are rather paying heed or attention to the assets and liabilities or the composition of assets and liabilities. We are raising a prominent question whether the business is adding value or not. Now, there prevails different approaches to value added orientation. To start with, there comes economic value added model, there comes market value added model, there comes shareholders value added model. Economic value added simply represents the difference between net operating profit after interest and taxes and the capital charges. So if we are there to offset all the capital charges against the net profit available, we are there to calculate what is the value added during a particular financial year. So based on that, we can go for the valuation of a company. Higher the quantum of value added in a particular business, obviously higher would be the value of the company, and vice versa. Then there comes market value added approach, where we are considering the market value of the company and we are offsetting it against the total quantum of capital employed in the business. The difference will be the market value added, and again here the same decision criteria is there. Higher the market value added, higher will be the value of a business. Then there comes shareholders value added, which is an extension of economic value added by adjusting the profit or the earning of the business to certain critical items on the perspective of equity shareholders specifically, because here we are specifically intending to know whether the company has added some value so far as the shareholders are concerned. Then there comes impediments to business valuation models. Obviously there prevails certain challenges to business valuation models. To start with, data related challenges. When we are going to talk about valuation of business, obviously we are there to avail of sensitive and reliable data on the basis of which we are going to make use of different models of valuing a business. But if the data or the raw input information is not available and accessible, then it is difficult, and many times the informations which are required for going for a proper valuation of business is not made available to the valuer. So that's why it is one of the fundamental impediment. Then there comes market pervasive forces. We all know that the value of a business is conditional upon the external forces to the business. So if the external forces are going to be highly unfavorable and vulnerable, the quantification of value based on all the models of business valuation is going to get distorted, owing to the simple reason that market pervasive forces are beyond the control of the corporate entities. So, based on the financial matrices available at the end of the body corporate, we are going for the valuation, but they can be significantly challenged and altered owing to the unfavorable consequences of market pervasive forces. So, that is why it is a fundamental impediment to all the business valuation models. Then there comes assumptions. As we know, we are there to assume a lot of things with regard to different financial matrices when you are into the protocol of calculating the value of a business. Like say for example, when you are going to go for discounted cash flow, we are assuming that the business is going to continue forever, as if the business is into a state of perpetuity, and whatever the sales are going to grow, we are assuming that the sales will continue to grow at the same rate, but pragmatically this is not the situation. So, one way or the other, all the models are based on certain assumptions. Then there comes behavioral and strategic factors. The valuer is also easily carried away by their hunches, the prejudice, the ego state as a valuer. So, if that is going to prevail in the protocol of valuation of company or calculating the economic worth of a company, these are falling easy prey to the behavioral dynamics of the person who is into the task of valuing or calculating the value of a company. Then contrary to that, there comes the strategic factors. We are assuming that the peers are going to adopt a very destructive strategy and the company is going to be facing an unfavorable consequence. Now, we may devise a strategy to come out of that particular orientation, but that is very difficult to pinpoint and dig out when you are going to go for a valuation of business. So, strategic factors are to a certain extent very difficult and they are rather very hazy when we are talking about valuation of business. Now, putting all these things together, the valuation of business is sensitive owing to the simple issue that the users community, may it be external users, may it be internal users, whoever they may be, they are inclined to ascertain the value of the business in the best possible way, in an objective way, so that the decisions can be executed in a rational and informed manner to serve their manifold purposes. I hope we have discussed and deliberated on some of the fundamental aspects of the valuation of business through business valuation models, and in the subsequent lectures we will be going into the deep orientation of all these models. Thank you for your attention.